Hi and welcome to SIMAX FinTech Weekly Market Insights. This is part 1 of 4. First of all, our disclaimer. So trading involves the potential risk of loss of capital. It's not suitable for everyone, but as I always say, hopefully it is for you. Many companies provide leverage, so just be careful because you can lose substantially more than your initial investment. Everything included in here is just purely for educational purposes, and we are not trying to encourage you to trade or invest. That must be your decision, and before you make that decision, consider the risks involved, your financial situation, level of experience and risk appetite. And of course, only risk capital you're prepared, but more importantly, you can afford to lose. Any doubts whatsoever, seek independent financial advice before you risk your capital, please. Okay, so here we go. Looking back at last week, plenty going on. So GDP came in low, only 1.1% year on year for the US. Housing data did improve though, despite the higher rates. I think maybe people are just getting used to that now. PCE remains sticky. Just remember that's one of the Fed's favourite metrics. There was hardly any change there. It's difficult for the Fed not to increase rates again this week, I would say, especially with employment costs still rising 1.2% in the first quarter. Chicago Purchasing Managers Index surprised on the upside at 48.6. Jobless claims were pretty flat. If we look at durable goods, they were much higher than expected. They came in at 3.2%, but then Richmond Manufacturing Index dropped more than expected. Manufacturing does seem that sector where it just seems most under pressure of all of them still at the moment. Then oil inventories surprised. There was a big drawdown of over 5 million barrels. Then of course we got back to banks at the end of the week, and of course it's First Republic. They crashed, unfortunately. There was potential hope for the government or the Fed or even one of the big banks that had deposited part of that 30 billion to come to the rescue, or even the FDIC, but that was not to be. I've got a question for the banking supervision in the US here, because they just seem to be missing something. Why does a bank, just because it's got less than 100 billion, require less scrutiny and stress testing? Investors want to feel safe wherever their deposits. Their cash is important to them. So, okay, they're protected up to 250k, but that may not be enough for some. There's been a lot of talk, and we always have this, too big to fail. Well, now it seems there's also too small to save. So we need to watch the smaller banks this week. There could be outflows, obviously going into the big banks. I'm just guessing now, I'm not sure, but we'll soon see. Now, Tesla cutting prices on some models is making profit margins very tight. And, big question there is it going to trigger a price war? Their share price keeps dropping. Didn't Musk do well selling all those shares over the last year or so? If you look back at October 21, the price was over $400, and then only last year it was over $300, and now it's down to around about 164. On the other side of that, there's competition, of course, that's building, especially in China. BYD profits soared 400%. That's the one that's backed by Buffett, and they now have 40% of the EV market, which again is, a very healthy share and eating into Tesla's share, I would guess. In the EU, GDP just about kept positive, and it was 1.3% year on year. In Germany, CPI came in at 7.6%, GDP flat 0 quarter on quarter. They're still flirting with recession, and of course that's despite China reopening. In Australia, CPI ticked up quarter on quarter and year on year, but monthly data shows some progress against inflation. The core was 6.6% year on year. You know, it's still 3 times what the target levels are. In fact, that's being generous. China's rebuilding ties with Australia. Japan, Ueda left rates negative, but there was no future guidance, and he plans to do a review of policies over the next 18 months. However, with CPI up to 3.5%, I still expect him to move rates positive this year. So, hope you've enjoyed this little look back at last week. Here's just a look at some of the things we do, apart from obviously these YouTubes. So daily newsletter, global news, my views, fresh daily chart levels and pivot points. One-day workshops just to help you fill in any gaps or find out if trading could be a career for you. 1 week courses, we will get you by the end of that first week feeling confident and having a reasonable understanding of trading. Is it going to make you a trader? No, but it's certainly going to give you the foundations to build on. And of course, if you've got an inner trader, I'll find it for you. Then if you really want to make trading your next career, then our accredited masterclass will be the one for you. It's designed to provide all the knowledge and trading tools required to navigate any market and also any asset class. Then on top of that, we do trader mentoring to help you to get to the next level time and again. Consulting to companies, individuals as well, hedging FX and commodity exposure. Providing trader education content to individuals, exchanges, brokers. We just want to help as many people as possible. And then of course, if you're underfunded, then we have a challenge that you can go through to get a funded trading account with one of our partners. So that's definitely worth checking out, and the link is there. Any questions whatsoever, contact us at info@cymaxfintech.com, or you can reach out to me with any trading questions you might want to just send straight to me, which is chris.tubby@cymax-int.com. Okay, hope to see you in part 2.